Yeah, thank you, Marty. And for those of you who don't know me, my name is Jeffrey Huge. I am the CIO at JWH Investment Partners. It's my own firm. We're mostly a research shop, but we're also a family office ourselves. I spent 25 years on Wall Street working for a number of the big banks in equity capital markets before joining my uh, most recent firm, which was the Leuthold Group, as a co-portfolio manager of a global macro hedge fund, the late great Steve Leuthold of Leuthold Group fame. From that point, I really kind of decided what I wanted to do is kind of focus on very big picture, long-term trends and how they affect the market. And probably the most important trend I've discovered in all of my work has been the one I'm going to show you right now, and that is our economic cycle model. This model is basically a function of about 115 years of quarterly price data taken from the most cyclical price series in history, in the history of finance, most likely, and that's the Dow Jones Transportation Average. And what we're doing here in this chart is we're looking at it through the lens of its own long-term momentum. So we're looking at 10-year trend momentum here. And so if we kind of view what's happened over the last 115 years, we can see a very discernible sine wave. And that sine wave has tended to peak and trough with the economic cycle. And so what we believe has occurred over the course of the last roughly 18 to 24 months is we've put in a top in economic momentum. Does that mean that the economy has topped and it's going to crash? No. It means that the wind is no longer in our sail, it's in our face, okay? And so what we have to look forward to, I think over the next 17 years, give or take a couple of years, this is one of the numbers that kind of resonates with this cycle that we've identified is that it is a 34-year, a Fibonacci 34-year trough to trough cycle. And so if we peaked in mid 2022 at the optimized peak of the sine wave, then the next trough based on that sine wave will be about 2039. So, for the duration of that period, we should expect economic momentum to be really kind of not working in our favor. In other words, the wind is in our face. What might be confirming that in the markets? Well, we have spent a lot of time looking at 2024 from a market topping perspective. And this data goes through December 31st. So we're not taking into account anything that's happened here the first couple of weeks of January. But behold, the bull market of 2024, virtually every single asset class and index topped in 2024 and is down, by some degree. High yield bonds are down a couple percent. S&P was down about 3.5% coming into today. We got a bit of a pop here in reaction to some data. But the long and the short of it is most of the major averages globally topped in 2024, and about 2/3 of them are down double digits. And in the case of Brazil, down 35% from its peak. So a lot of people feel like we're in this raging bull market. And I think that the raging bull market may be behind us going forward. One of the things that jumps off the page as an indicator of where things are going is this particular relationship between the NASDAQ 100 and the semiconductor index. Many, many years ago, a guy by the name of Charles Dow, who founded Dow Jones Company and the Wall Street Journal, came up with a way to kind of determine whether we're in a bull market or whether we're in a bear market. And he called it the Dow theory indicator. And basically what it said in simple terms is that when the Dow Jones Industrial Average is making new highs, the Dow Jones Transportation Average should also be making new highs to confirm it. That the companies that manufacture the goods and the companies that transport those goods should both be making new highs at the same time to confirm that the economy is working in harmony, right? And when they're not, then something is amiss. And usually when we get a non-confirmation in that, arcane indicator, the Dow making new highs, yet the transportation not making new highs. It was a negative divergence or a non-confirmation that indicated a change of trend. Well, we think that, like I said, that was an arcane relationship. The economy is really much more digital, not analog, not a manufacturing economy anymore. And as a result, we think the NASDAQ 100 has now taken the place of the Dow Jones 30 as the key index to watch in that kind of Dow theory indicator. And the transportation index has been replaced by the semiconductor index, which creates the power and um, the potential for moving that digital product faster. In other words, it creates the speed of that transition. And what we're seeing today is while the NASDAQ 100 made its high in December, around December 10th or so, the semiconductor index didn't even come close. It's left in place a very glaring negative divergence or non-confirmation. And this negative divergence is a precursor to a change in trend, which we think is now beginning. We're in the very early stages of that change in trend. One of the things that has us concerned about equities right now is valuations. We're just off record valuations. We could see here from a price earnings perspective, and this is Professor Schiller's approach to calculating the price earnings. It's cyclically adjusted for margins and inflation. And the last time we got up to the levels that we're at today, around 37.5 or so, was around 2021, right before we saw the market take a 20% or go into a 20% drawdown phase. Prior to that, the highest that this indicator has ever been was back in March of 2000 at the peak of the dot-com bubble. So for the third time, we're kind of approaching these levels that have historically left the stock market wanting in terms of its forward performance. Other measures of valuations like the dividend yield of the S&P 500 are now plumbing its all-time lows around 1.25%. The price to sales ratio actually posted an all-time record high in the last 30 days, over 3 times. That far exceeds the 2.2 times that we saw back during the dot-com bubble, and even the level that approached that 3x point back in 2021. And price to book value also at an all-time record extreme, greater than 5 times, which was the peak back in the dot-com bubble. So these record valuations have us very, very concerned. Another one that we're not illustrating in this chart is the market cap, the GDP that so famously is followed by Warren Buffett. That has recently exceeded 200%, a level that far exceeds what was seen back at the cyclical highs of the dot-com bubble. Got to about 142% back then. So these extremes in valuation basically give us a cap on the upside for returns in the S&P 500 going forward, because it's unlikely that the Schiller PE ratio is going to go to 47 times. It's not impossible, but it's unlikely. It's unlikely that price to book will go to 6 times or price to sales will go to 4 times. Not impossible, but highly unlikely. So we think it puts a bit of a cap on the upside potential for stocks going forward. Another concern that we have is record systemic leverage in the system. There's many ways to measure leverage. The options market, the levered ETF market are all showing, record levels at this point of investor involvement. There are small traders that now have 100 times more committed to the market on the long side than large traders and commercial traders. And so all of these things together, combined with what we're seeing in, kind of the straight up margin levels, which are reaching extremes. We're not at all-time record extremes in margin, but we're, 3 times what we were back in 2007, 2008, preceding the great financial crisis, and back in 99, 2000, preceding the tech wreck. And so the levels are extreme. What's even more extreme is the negative balance, and that is margin debt less cash on the sidelines. That is at an all-time record high of negative $553.5 billion. It's never, ever been that high. In fact, it peaked around a little over 100 billion and before the tech wreck, and a little less than 100 billion before we saw the great cleansing of the great financial crisis, which took us down to positive balances approaching 200 billion. So we're some 750 billion away from that right now, and that is a lot of leverage to have in the system from a straight up perspective, not even including all of the derivative forms of leverage that we can add on top of this. Another chart that has our attention is credit spreads. We've overlaid this chart on the CBOE VIX index, the volatility index, just to give you a sense of how correlated they tend to be when we get big changes in credit spreads. Well, the last time credit spreads were at the level that they're at today was during the great financial crisis, just preceding that crash. And so, if we look back there, here's where we were, and credit spreads effectively blew out with the VIX to levels never seen before. Where we are today is exactly that same realm where credit spreads are extremely low. And what is that telling you? It's telling you that investors see no risk. Investors believe that they can invest in high yield debt and not expect much more than, say, a couple hundred, maybe 300 basis points spread on top of that. So the risk that is perceived out there is very, very low. In other words, it's indicating complacency. And so the attitudes of investors have reached a level that is very consistent with past lows that have preceded major reckonings in the stock market and in the bond market. And so we believe that we're approaching another one of those points. Today, we got some very good news or perceived news on the CPI. That is that the core CPI actually came in a little bit lower than expected. What it's not telling you is that 5-year inflation expectations have turned up from recent lows, going back to just December. And from our perspective, it's not really the magnitude of the change that's important right now. It's the direction of the change, and that change has been one that's up and to the right. That's not where we want to be in terms of inflation expectations, especially given all the leverage in the system. What that really points us to in terms of where we should have our focus is 10-year Treasury yields, which are down 12 or 13 basis points today, responding to news, but in general have rallied up from lows recently of around 3.5% to highs of 4.8%. And while it's not a guarantee that we're going higher, what we're seeing here is that this congestion area is just a period of consolidation in a larger degree trend that appears to have broken out. Okay, this chart goes back to the 1980s, 1981. We actually peaked here in between 81 and 82 at 15.5% on the 10-year Treasury, and got down to a low of around 70 basis points or so in 2020. Since that point in 2020, we've broken out from that downtrend, and we are now on the verge of breaking out of this key resistance level at 5.5%. I'm not saying that if we push above 5.5%, 10-year yields are going to spike to 12%. But what I am saying is that the trend based on this price action projects a measured move to 12% at some point in the future. That could take years to achieve, but the trend is now up and to the right. And so I think we've seen the lows in 10-year Treasury yields, and we need to prepare for higher yields. A breakout above 5% would very clearly get us up into the 6.5% range over, say, the next 12 to 18 months. That has our attention because higher interest rates are what compress PE multiples. And that's the key with valuation right now, is that it's not so much a problem with earnings. Like back in the Nifty 50 days, people bought the top 50 stocks, right? The McDonald's and the Xeroxes of the world, right? And the IBMs of the world. And they paid huge multiples, 50 times forward earnings, because they thought, well, these companies are great growth companies and they're going to grow into their multiple. And guess what? They were right. These companies actually did continue to grow. The problem was the PE multiple compressed during that period of time. And most of those stocks saw anywhere between 60 and 90% declines. Polaroid went bankrupt. Eastman Kodak is, has gone bankrupt and recovered and is a fraction of what it ever was of its former self. And so, these are the concerns that we have to have, is that it's not so much that these great companies like Microsoft and Apple and Google and Nvidia aren't going to endure and continue to grow. It's just that they're not going to be, you're not going to see people paying multiples like they're paying today for the earnings that they're generating. And so our expectation is for significant multiple contraction over the next 12, 24, 36 months among those top weighted stocks in the S&P. And as Marty pointed out, those top 7, now known as the Magnificent Seven, account for a little over 30% of the market cap of the S&P. The top 10 stocks are actually closer to 40%, and the top 20 stocks are about 50% of the market cap. The top 100 stocks are 70% of the market cap of the S&P 500. And they trade at a very, very large multiple relative to history. And so, what it does is it caps forward returns. One of the things that has our attention right now is small caps. There's been a lot of talk about this expansion in breadth, right? This increased participation of smaller cap stocks. Well, we're not seeing it here. We had some increased participation into kind of the late November timeframe into last year, and that was certainly had people becoming more and more optimistic. In fact, we challenged the old highs from actually November 8th of 2021. That was the old high. We just squeaked above it on an intra week basis. We never did get above it on a closing basis. And so what we've done since is we've retrenched dramatically, a good 12, 13% down from those highs. But we're now holding above what I would call support, right? Key support. And if we continue to hold, then maybe there's some potential that we could go higher. But, what we're seeing here is the 200-day moving average has been pretty critical. We've tested it, we've tested it repeatedly over the last, year or so. And now we're testing it again. And I think if it breaks this time, we're going to see a very quick move down to the 200-week moving average. And if that can't hold, then I think we're going to see this pattern play out, which we would describe as a corrective 3-wave A, B, C pattern, which could carry the Russell 2000 down by over 50% before we see it terminate to the downside around 100 or so based on the IWM. We confirm what we're seeing in the Russell 2000 with the value line geometric index, which has actually failed to make a new high. It last peaked also on the same exact day that the Russell 2000 peaked, and that was November 8th, 2021. So quite some time ago, and we haven't really even come close to recovering that old high. Now, what's the difference between the Russell 2000 and the value line geometric? Well, the value line is the top 1,700 stocks in the United States based on revenue. So it includes Apple and Google and Nvidia and Microsoft, whereas the Russell 2000 are the bottom 2,000 stocks in the Russell 3000, right? So they're the worst companies. Here we're covering basically the best companies by revenue. And what's happened here, again, the same thing. We've seen this choppy overlapping advance off the 2022 lows, yet we have not made a new high. And what's happening, we're coming back down to test that 200-week moving average. And I think if it were to give way, the pattern would likely play out this A, B, C kind of recovery, which could very well only reflect the A wave of a much larger degree pattern that we envision playing out over the next, say, 15 to 17 years with respect to that larger degree economic cycle that we discussed. This is a strategic view of the S&P 500. This goes back to kind of that 2020 COVID low, and we can see this rally up into the January 2022 highs, the pullback into the October 2022 lows, and then this nice advance, which has kind of tricked us all the way up. We thought it was kind of a corrective advance here, and then we got the pullback, and we kind of expected this to to move lower, and it didn't. It shocked us. We got big news out of NVIDIA and some of the other big tech companies, which caused things to move up. And we also had a lot of focus on the Fed at this point in time. And everybody expected the Fed to cut rates by 7 times at least during 2024. Well, we never got close to 7. We actually got 4. And now the street is kind of thinking, well, maybe the Fed got ahead of itself. Maybe they're done for the cycle. Well, time will tell. We can all play the guessing game of what's the Fed going to do next. My suspicion is they're not going to do a whole heck of a lot for the foreseeable future. It appears to us that the economy has moved into kind of a hotter sort of sustainable area, and we're not seeing the sort of risk of recession that we had been seeing in our models, say as recently as September of last year. And what it tells us is that we could very well be in for a hotter than expected recovery off the most recent low, infused by Fed rate cuts. And that could, in fact, result in some inflation. We're starting to see some evidence, not in the CPI core so much, but in energy prices. We've seen the WTI crude future now trading up around 78 from a recent low of around 70. And so, that recovery and strength in energy prices does have a tendency to move through the economy rather quickly. What we see in this kind of strategic view of the S&P is that it's traced out an impulse wave. And we think it's the final impulse wave of a cycle degree wave that started some time ago. About October, or I should say actually March of 2009 is where we think this cycle wave 5 began. And we think this last leg here was primary wave 5, and we counted up at intermediate degree 1, 2, 3, 4, and this last move up here into the recent highs in late last year, call it November, December. We think we saw the peak in the S&P 500, probably December 6th was the high. And what we've seen since is a pullback here into this key support area. It's trend support, it's chart support, and it's also moving average support, the 200-day moving average. And we think that key support level around 5,600 or so needs to hold. And if it does not, a break below that would confirm a move down to the 200-week moving average of 4,600. So that's what we're thinking about from a strategic perspective in the S&P. From a more tactical perspective, and this chart was printed out last night, so we don't see the bounce up here that tags the 50-day moving average today, which we think is a counter trend advance in a larger degree impulse that will carry the market much lower. But if we're thinking about the subtle moves, the nuances of this advance, the wave 4 low, which came in August of last year, August 5th, where we saw a big spike in the VIX, has now traced out 5 waves up at minor degree, 1, 2, 3, 4, 5. And we think that completes this advance, as I was saying, from a strategic perspective, as well as a tactical perspective. This pullback looks like it's impulsive to us, 5 waves down. We count that as minor wave 1 of a 5-wave move at one larger degree of trend. The advance up to this level was minor wave 2. And we think this is minute wave 1, minute wave 2, and minuet wave 1, minuet wave 2 to here. And we think that this is going to be a third of a third wave decline that carries the S&P down here to the 200-day and through it, and probably down to around 4,600 before we find the market, gets a good footing. One of the things that has us convinced of this is this negative momentum divergence that continues to persist, going back to kind of the July level highs, where we saw a high in the S&P on July 18th, a similar high in momentum. And when we made this new high in December, we made a much lower high in that momentum study. And so that tells us that we're seeing momentum has already crested and it's waning. And so we should expect this kind of classic pattern top of the head and shoulders variety to resolve to the downside eventually and carry prices much lower. So year to date, we've seen sector performance favor energy. And like I mentioned, we've seen a big spike up in crude oil prices from the recent lows of around 70 to now 78 or so. Tech has really kind of lagged the market. Here's the market, as of last Friday, it was, up, or I should say down about 1% or so. Um, you know, Com down 1%, discretionary down 1.5%, tech down 1.5%, financials down 2, real estate down almost 3.5. But we've seen energy leading up 3%, healthcare up 1.5%, utilities pretty flat, industrials kind of flat with the market as well. So we're focused on this energy because it was one of the big underperformers last year. We think it's due for a pop here in the first quarter, and we're starting to see that play out. When we look at sector valuations, we can look at where energy trades relative to the market on 2025 earnings. It's now trading at a 34% discount, whereas tech and all the popular tech leadership stocks traded about a 31% premium. So we think there's a big opportunity, about a 65% relative discount for energy relative to tech right now. And we think if we start to see the multiple compression that we believe is likely over the next, say, year or so, we could see energy hold up on a relative basis much, much better than, say, the big technology stocks. So we think that's going to be a great place to hide out during this period of PE multiple contraction that we envision as rates move higher. And so another way we're looking at tech again here is this is the tech sector making its high in December, but this is tech relative to the S&P making a lower high, actually struggling with its 200-day moving average. And we believe that negative divergence here is kind of confirmatory to what we're saying about tech. We're not quite seeing that play out in energy. Energy did not make a new high. It failed. It kind of tagged its old high here. We saw a lower high as well in the relative, but we're starting to see an uptick here in relative strength. And we're in very early days, but we think energy, once we break through, if we break through this level here, the 200-day moving average on a relative basis, we think that could be the beginning of a big move higher in energy. So that's where we have our focus on energy right now as a way to try and outperform during, say the first quarter to the first half of 2025. And with that, I want to bring your attention back to crude oil prices. Crude oil here trading as of last night's close in the 78-ish area, breaking out from this series of downtrends here. We think the potential is to move up to around $95 a barrel over the course of the next, say, 6 to 12 months. And we think that is going to lend a lot of credibility to the energy story in terms of earnings in energy. And of course, we see a lot of room for multiple expansion there. So with that said, I would like to conclude my presentation by just saying, if there's anything that we've talked about here that you would like to learn more about, you can find additional information on our website at jwhinvestment.com. You can also follow us on Twitter X at alpha_insights. And we write a pretty popular financial newsletter called Huge Insights, The Big Picture. It's available on Substack at hugeinsights.substack.com. So any of those places you can find out more about us.
Hey, Jeff. So we have some questions here. Just when I get started, can you hear me?
Yeah, absolutely.
It seems like you're pretty positive on energy outlook, et cetera. What's your anticipation in terms of, oil prices and things along those lines?
This is what we think is going on in oil. We see a breakout here from this downtrend, right? And that's pushed us up to around $78 or so. If we can push above that 78 sustainably, I think we can probably get up to, the mid 80s by the end of the first quarter, and potentially up to the mid 90s by, say, 4th of July.
And that includes even with Trump's policies that are pretty favorable towards drilling?
Well, I think a lot of those drilling policies are going to take time to get implemented. We could see them take upwards of a year. The other thing is the thing that's driving oil prices right now is increased sanctions on Russia. One of the things that Biden and Trump had in common is they tended to have similar foreign policy. We do not think that the Trump administration is going to change their foreign policy approach to trying to contain Russia in the Ukraine. We think there may be some tough talk one direction or the other, but we think the policies will remain in place. And we think these sanctions are widely agreed upon, on both sides of the aisle, as well as key military decision makers.
So you had some comments on general outlook, et cetera. Are there any positive outcomes that might change your assertions or perspective?
Well, yeah, maybe earnings grow at a much faster rate than the street is assuming. We're not even projecting lower than consensus estimates. We're assuming that the consensus is correct, right? And that the top 100 stocks are going to continue to grow their earnings like the consensus believes they will, and that would get us to say over $300 in earnings in 2026. The problem we have with that is we just do not think that the market will sustain a cyclically adjusted multiple of 37 times on those earnings. We think it's much more likely that that multiple is going to compress by about 50% down to say 20 times over the next 12 to 24 months. It's not going to be a linear process. It will probably happen gradually, then suddenly.
So, I mean, the expectation that some macro expectations like the Russia-Ukraine war will come to a stop or a halt, and maybe that will alleviate some of the conditions on Russian oil, or it seems like the Israel conflict is coming to a halt as well.
Well, there's a truce, and a prisoner exchange. They're going to stop fighting for maybe a few days. I don't know that it's going to last. It's going to be persistent or permanent by any stretch, but it's a start, right? And the market's responded to that along with other data, and it's just gotten back to its 50-day moving average to touch the lower side of that. I don't see this as being game changing. Israel and Hamas is not a big part of the global economy. Neither is Russia, for that matter. The Russian economy is about the size of the Texas economy. So, the oil industry will do just fine with or without Russia. It's Russia that's going to have the problem. And, we think that the war in Ukraine will end eventually. It will probably end when Ukraine stops resisting. And the one thing Trump's policies might change is they might stop funneling money to Ukraine. And when that occurs, then Ukraine won't have the ability to defend itself anymore. That it's debatable whether the Republicans will push that forward, because they've been supportive of it. It's been a bipartisan support of Ukraine so far. So that would be a big change if that did happen. But I don't think it's going to change earnings, right? It might change sentiment, but sentiment's so extreme today, I don't know how it could get any better.
Do you have any thoughts on AI?
Well, yeah, just what everybody knows, right? It's been hyped up to a point where it probably won't live up to its expectation. The expectations are extraordinarily high, and already we're seeing the Blackwell chip is failing to deliver, and people are canceling orders because of that, lack of follow through in terms of performance, right? And so I think there's going to be a lot of that. I think that the big problem is software isn't keeping up with the hardware right now, and so there's got to be a lot more developers enabled to, produce great software programs, and that's going to require them having access to these huge data centers. And so, there's just a long way to go. I think we're in very early innings, and it may be that it is game changing, but I don't think it's going to change GDP growth or earnings growth for the vast majority of companies. I think, a few companies are going to win, and those companies are already extraordinarily highly valued and maybe overvalued. I think they're certainly overowned and possibly overhyped.
Thoughts on AI in the audience here, or I mean, is it going to be a boost or is it going to be a job killer? Thoughts? Yeah.
It'll be both, in the sense that it's going to increase efficiency, particularly in the software sector, dramatically.
Can somebody give him a microphone?
Hi, I'm Jason Barber. I'm with SDC. And my background's in AI and machine learning. So I think it's going to have two impacts. One is it's going to have an extraordinary impact on the productivity of people, particularly in technical disciplines. That could lead to reduction in headcount there, but those savings will largely go to increased spending on compute. So I don't know that the overall footprint in terms of spend of the individual companies will change, but their productivity will probably go up. And
so maybe it might impact employment a little bit.
I think it will impact employment, particularly people in the tech sector. But the other big thing we're going to see is the rise of what people call AI agents, which means is autonomous AIs that can actually function as employees inside of organizations.
Jeff, any thoughts on AI as a job destroyer?
Yeah, I think exactly what he said. I don't think the cost savings are going to go to the bottom line. I think they're going to go to incremental investment because once you start to experience that productivity, investors want to see a trend. They want that trend to improve. And, I think that's what companies will be focused on trying to do is, increase productivity as a trend in the organization. And so it'll have a difficult time finding its bottom line impact.
Yeah, and so another question I had for you is, a lot of people don't. So I think that there's a return to mercantilism from globalism, and so I think that will, on average, help the American people, but I don't think it's going to be helpful for the top 50, Fortune 50 companies, right? Because the top 50 companies are highly global in nature. So I think any kind of, things that Trump does in terms of tariffs may be negative towards large globalist companies. Any thoughts on that?
Yeah, we wrote a very detailed report 2 months ago. It was I believe, our November 1st, or actually our December 1st report on Huge Insights that totally focused on tariffs. And what we did is a deep dive on the Smoot-Hawley tariff impact. And a lot of people don't know this, but the Smoot-Hawley tariff only increased tariffs by 20 percentage points. They went from 40 to 60%. So we already had heavy tariffs. What Trump's talking about doing is taking our tariffs from 2 to 4% today, depending where we're talking about, to somewhere upwards of 25 to 50%. So that would have an incremental impact that is at minimum the same impact as the Smoot-Hawley Tariff Act had, and possibly double that. I think if it got to a point where it was 50% tariffs on China or something like that on certain products, I think it would have an absolutely irreversible negative economic impact, that it would send the economy into some form of extreme recession, if not depression.
What about NATO spending? I mean, I guess there was a conference with Trump the other day, and he said that NATO spending should be 5% for each country rather than 2% for the European countries. Any thoughts on that?
I don't think it's big enough to move the needle in either direction.
I was just wondering if that's really just a ploy to get European countries to, balance out their trade with the U.S. by buying more military equipment.
Possibly, yeah. I think that it's basically more of a negotiating tactic for Trump to basically threaten them, either pay up or we'll reduce our support for you, that sort of thing.
Great. Let me see if I have any other questions here. Yeah, I don't know if people were here in Silicon Valley. I don't know if people here have a connection or thought about a connection between, Peter Thiel and his kind of world outlook, and the fact that a lot of the people that are in Trump's organization are now Peter Thiel acolytes, right? I mean, J.D. Vance worked for Peter Thiel. Trump is espousing mercantilism, which I think is a Peter Thiel thing. Any thoughts on that, Jeff?
Honestly, I don't have any thoughts on that. I haven't thought about that at all.
Okay, great, great. Any other questions? Any questions online? Well, Jeff, listen, again, as always, eye-opening, and thank you so much.